Guys, welcome and thank you very much for joining me. So are we already in a bear market? Did we start? Are we in the beginning? Like, did we just enter an official route towards a very severe market crash? You stick around. Trust me, I beg you to stick around, guys. Not for the views, but for the charts that I'm going to show you. That if you like scary movies, if you're a fan of scary movies, the scariest movies out there, and thrillers and all that stuff, then you're going to enjoy these charts, because these charts are going to scare the living daylights out of you. So together we're going to learn something. We're going to look at past historical trends for the past 24 years. Every time, this is insane, guys, this is crazy. Every time we had peaked, the Fed rate, the interest rates peaked where the Fed would stop and say, okay, this is it. Now I'm going to start going. Now I'm going to start cutting rates. Every single time that happened, the same exact thing occurred, which is scary. I'm going to try to get to it. So let's go. First, July 31st, guys, Tom Lee said the following: stocks will rally 5% in just 5 days after the Fed's rate decision this week. Well, none of that happened. He was wrong, and I'm not criticizing him, but he was wrong. You can see that even the greatest investors, some of the best people out there, can't get it right. You see now 2 days, the stock market is crashing really hard. But you know what? Earlier in April, guys, 2024, this year, the Dow Jones had a much more severe crash, and it went unnoticed. I mean, no one really, I guess, cared. It wasn't that big of a deal. The same thing with the S&P 500 earlier in April. It was much bigger than what it is, well, sort of, than what it is now. And for the NASDAQ, well, no, it's just gets worse now.
We're all gonna be rich!
You broke even!
So, Federal Reserve focuses monetary policy on fighting inflation, right? Okay, cool, nice title. By the way, I'll leave a link in the description of the video so you can check out this article. Key takeaways: as anticipated, the Federal Reserve held interest rates steady at its July meeting. I see that today we're going to have another red day for sure, because the July jobs report came in bad. Higher unemployment, less jobs created. So let's get back to this article, though, because you want to see the charts that I told you that will scare the living daylights out of you. The Fed's policy-making Federal Open Market Committee, FOMC, hasn't changed interest rates since July 2023. Markets anticipate that the FOMC will, in September, likely cut the Fed funds rate in control for its first time since 2020. Keep the words Fed funds rate in mind, and let's look now at the federal funds target rate from 2000 to 2024, the last 24 years. Guys, I'm begging you to please pay attention for your own good. Please, not for views, but for your own good. This is very interesting. Prior to 2000, prior to the bubble bursting in the dot-com bubble, and following after that for a couple of years, a severe market crash. Now, this is in the stock market, right? It's not the S&P 500, it's not the Dow Jones, it doesn't show any market crashes here. What you're seeing here is the rates. We had rates going up, and so rates were going up, and then when they peaked and the Federal Reserve decided to cut rates, and they started to cut rates, all right, so in 2000, they started to cut rates. What happened then? The market crashed. Did it crash specifically because of the Fed rates going down? No, but there's a trend which is scary. In 2005, 2004, 2003, we had new rates going up. Federal Reserve decides in 2007 to start cutting the rates. We had the 2008 market crash. 2018, 2019, same thing. 2020 market crash, although you can attribute that to the COVID. Look at this now, guys. 2024. We reached the peak. We're now at a 5.5%, whatever it is. And the Federal Reserve says, maybe. might be the time when we start cutting rates. But I know historically that whenever they started cutting rates from the trend, we had severe market crash. So to make more sense out of it, in the year 2000, 1999, 2000, the interest rates were there. When they started to go down, the interest rates, what happened? Look at here. This is now the S&P 500 that you're looking at here on the right. Went down, right? If you look at the year 2005 to 2007, 2008, what happened after that? The rates started to go down. What happened after that? Here, let's go. 2007. You see that? 2007 right here. The S&P 500 went down. 2019, 2018, rates started to go down. What happened in the stock market? Here's 2019. Here it is. Rates. Now this is the S&P 500, but it's interesting how when the rates go up, here's the S&P 500. When rates go down, we're at 5.5% now in 2024, right? So interest rates started to go up for the past couple of years, right? We reached the 5.5%. There's talk of, okay, that's enough. We now need to start cutting them. Here it is, 2023, 2024, S&P 500 always going up. What happens when we start cutting rates? Well, if Jerome Powell decides in December to cut the rates, then what's going on? Is the economy really bad? Or what's going on? The same people who are saying, hey, we need a rate cut, now they go on TV and they say, oh, I don't know, what's going on? Why are they doing a rate cut in September? Or, is the economy screwed up? Oh my God. Also, what's interesting, it says here in this article, it appears the Fed is more focused on trying to work off its book of mortgage-backed securities than anything else. And here it is in the chart, guys. Assets held by the Federal Reserve. I mean, this was a sign. This was also another sign that, but it's kind of hard to follow it because you don't know, like as you're following it, is it going to stop here? Are they going to increase their assets or what's going on? But the Fed has been reducing dramatically the assets held from 2022, guys. All right, and moving now on to the automotive industry to understand why the stock market is not just about the rates going down, but it's also about a weakening economy. And if you want to find out whether the economy is weak or getting weaker and what's going on, it's not the only thing that you should look at, but one indicator is the sales of automobiles, cars. So the automotive sales, guys, volume in 2024 in the USA. Does it look fresh and healthy in this chart? Well, you kind of can't tell, right? Guys, it's down 11.4% year over year, 11.4%. Reasons. Well, I can tell you right now from me, because I'm fresh off buying a new car. I just bought a new car last week. I had been driving, guys, for the past 10 years, nearly 11 years, a small car, very small car, Mitsubishi Space Star. Let me show you a picture. Now in 2014, well actually I think mine was a 2013 model, but anyways, I paid just $10,000 US total with taxes, with everything, final price with the key at hand, 10,000 bucks. And I got that car. This is the car, right? This was the 2014 Mitsubishi Eclipse. Brand new. Right? 10,000 bucks. That was in 2014. The same exact car, guys, in 2024, they gave it a facelift. That's all they get. Just the facelift, just the front. The back is the same. The inside is the same. Doors are the same. Everything's tires are the same. Everything is the same. They just did a facelift. 10 years later, 2024, you're paying $19,000 US for this car. Did the prices go up because of COVID, pandemic, lockdowns? Things messed up around the world, geopolitical tensions, shipping industry disrupted. Was this all the reasoning? It was part, but not all, in my opinion. I've always said to myself, no way. The automotive industry got together, in my opinion, and said, you know what? Now that the prices are, because of all the things I just mentioned, the reasons, the prices are up, and now we have to sort of sell the cars higher. Let's push the prices just a little higher also, and then just keep them there. Doesn't matter if our raw materials and all our expenses go down. No, we're going to keep the prices up because it makes more money for them. How automakers are earning a bundle while making fewer cars. Now, this was in 2021. So we'll make less cars, we'll create a problem in the demand supply, and we'll charge you a lot more for them, and we'll make a shitload of money. Just my opinion. this article seems to agree with me. But the biggest story of the stock market yesterday was Intel, guys. Intel dropping so hard. Wow. I bought it yesterday at $23.80. Someone said I jumped in too early. No, I could care less, because if you don't know how I invest, yeah, you would say that. But if you know how I invest, I don't go all out ever. I've said in my Discord many times. I don't know if people understood what I mean. Spread your money in many great companies, not at the same day, obviously, but whenever you are, just overall, just have your money spread in great companies, ETFs, diversification all over the place. Don't go all out heavy on any single one of them. Well, Mike, yeah, but if it goes up a lot, you're gonna miss out because you didn't buy many. Who cares? I don't care. Diversify. In the end, I win. The name of the game is to be green at the end of the when the game ends, and not be red. So I didn't buy a lot. I bought it at $23.85. I know it's down like $22.04. I don't care. If it goes to $18.17, I'll buy then my final purchase of what I wanted, and that's it. Let it go. It's a great company. I don't think that they're gonna have some volatility downwards for some time, 1-2 years, but eventually I think Intel is gonna turn around, and just the valuation point of it alone, when it becomes really undervalued, will be worth the move, in my opinion, to make profit. So making the right investments, guys, and it's never too late, but making the right investments and holding for the long term always works out in the end. Because it will only not work out if the U.S. economy is just destroyed, and then who cares about the stock market? For example, and I've used this example many times since 2020 when I created my YouTube channel, but it's an example that freaking works, and it makes sense, and it's like there, you can see it with your eyes. Fidelity High Dividend ETF. I'm not promoting it, but I'm just saying what long-term does if you do the right investment. No matter what happens, you're still up. Fidelity, if you're watching, maybe you want to sponsor a video. Come on, just, you got money. Don't be cheap. Anyways, and I said to myself, okay, I want this as part of retirement. So whenever I can, on a monthly basis, whatever I can, I'm going to pour some, I'm going to buy a little bit of FTVV, which is the ticker symbol. FTVV, for years now, FTVV. What happens now? We reached 2024, guys, and yesterday and the day before and today the market is crashing and all that stuff, and there's panic, and everyone's like, what's going on? What am I gonna do? I'm losing my money and all that stuff. But if you've been investing for long enough in the right things, for example, and I'm not saying you should buy FTVV, look where you're at now, and no matter what happens, you're still up. Berkshire Hathaway, the stock. Can you say that Berkshire Hathaway, by the way, is a bad company? That they have a bad balance sheet and all that stuff? I mean, risks. Obviously, there's risks for everything you do, whenever you're in life, and anything you're investing and all that stuff. I get it, but I think Berkshire Hathaway is one of the best out there, right? And Berkshire Hathaway, guys, had their stock go down 50% 3 times in its history. 3 for sure. I don't know about 4, but 3 for sure. And there was nothing wrong with the company. What would have happened if you had invested in the company with money you shouldn't have invested, and then Berkshire Hathaway goes down, the stock goes down 50%? You probably got destroyed, right? You probably exited with a huge loss, destroyed, and all that stuff. Forced out of it, right? So never invest with money that you need. Try to play the long-term game because it works. Buy stocks when they are undervalued of good companies. Don't buy a penny stock just because it's undervalued, right? Reduce the amount of times you try to do day trading, because day trading is gambling. So to wrap it all up, guys, looking at the charts that I showed you earlier in this video, whenever we had the interest rates go to the peak level and the Fed decides to cut them, historically, every time that happened, the markets would crash. And I hope that that doesn't happen. Now, someone would argue and say, come on, Mike, that specific crash was due to the housing crisis, or that specific crash was due to the dot-com bubble, and don't tie them with interest rates. I'm not, and you're right. They are due to other reasons. It's complicated, but it's a trend that I'm looking at, right? So let me know in the comment section below what you guys think, and I wish you all the best. Take care.